Alright, so then guys, today's Thursday, and if you have not checked out my latest video on the whole entire FOMC summary, you can check it out in my channel. I uploaded it this morning at about, I think, 4 a.m. or so. I forgot. I went through the whole entire FOMC, the policy statement, and afterwards I actually went through what Jerome Powell basically said during the Q&A. It was very, very, very good. Honestly, just go and watch it. It's 10 minutes. Okay, you're gonna get a lot of information from that, so just watch that. Okay, I'm gonna be talking a little bit more about it today as well, simply because that's one of the best news that we have in a very, very long time. So let's cover some news today. All right, so Fed's leave the interest rate by half point in biggest hike since the year 2000. So of course, people are saying that this is the biggest hike that we had in 2 decades. And what this actually means is that they are going to be shrinking their asset portfolio, which is their balance sheet. Right now, it's I think about $9 trillion. They're going to be lowering that, and afterwards, they are actually going to try to enable the labor market and the housing market as well. Afterwards, they actually are increasing by 50 basis point hike, bringing the interest rate up to 0.9% as of now. So yeah, pretty interesting stuff. Okay, even though us thinking that going up by 50 basis point hike is going to be a little bit scary. Even in one of my FOMC expectation video, I actually said it before as well. Okay, the moment the policy statement comes out to say we're going to be going up by 50 basis point hike, there's going to be a little bit of panic in the market, which evidently shows it. Okay, go to the 2 a.m. chart. Okay, go to the 2 a.m. chart and go all the way to 2:38. Okay, that was before Jerome Powell actually came out to give any sort of Q&A. You can see that the chart for S&P, for the Dow, for the QQQ, it didn't matter. Okay, the Nasdaq, S&P, Dow Jones, who cares? All of them went down, and the reason why it went down is because 50 basis point hike is still going to be scary nevertheless. Okay, of course, right now it's afterwards. Okay, like I said before, the moment Jerome Powell starts to answer some good questions, okay, especially with CNBC, okay, the answer when he answered that 75 basis point hike is not actively being looked at, that spiked up the market by so much. Okay, I was counting on this kind of question. I think that these are the ones that are really the one that actually spike and help us yield some good results from Jerome Powell. So very, very important. Of course, right now, if you're looking at the pre-market, everything is starting to kind of like trend down a little bit. And I'll have the news for that as well. Basically saying that the futures are basically slipping down a little bit because investors are reassessing what the Fed's actually said, which is also why, okay, I had this feeling. Okay, I'm gonna break this rule for you guys. It's a Thursday, and I'll tell you guys some of the trades I made yesterday. Okay, this is crazy because like I felt it in my bone. Okay, I closed up all my covered calls at 2:28. At 2:28, I closed off all my covered calls. So I took profits on those. I made about from anywhere from 17% to 60% for most of my covered calls. And then at 3:20 a.m. and 3:33 a.m., I sold more calls on those particular calls. And basically, I kind of managed to get a bigger yield, up to about 80% additional premium for those yielding. So I'm very, very happy about those. Of course, these are just basically my way of hedging, because nevertheless, whatever the Fed say, you can consider it as bullish. You can consider it as that this is great news and such. But let's not forget something that's super duper important, because nevertheless, Jerome Powell did mention that 50 basis point hike is going to be on the table for the next couple of meetings. So there is a very, very good chance that we might not be aiming for 2% this year. And if anything, we might actually go towards 2.5% this year, which I do think that that's a very, very high probability. Especially if the upcoming inflation report, which should be coming on the 11th or the 14th. Okay, if that comes out and then it basically just tells us, like, for example, core inflation is usually still going up. Of course, when you're talking about core inflation, you're actually taking away the volatile assets such as your oil prices and your food prices. So if the core inflation is still going to be going upwards, then I do think that there's going to be some form of a concern in the market. Okay, but if, for example, if the CPI basically just be like core inflation shows that it basically peaked and we are going to be seeing 0.2% for core inflation, month over month we might be looking at 0.6%, for example, because oil prices is starting to kind of simmer down a little bit, trying to find a little bit of a floor pricing. Of course, it's still nowhere near the floor of what we had before 24th of February, but ultimately we still have to live continuously. So because of that, I do think that there are still a lot of concern in the market, and that was one of the huge reasons why I was really contemplating as I was making the video for the whole FOMC summary. I was thinking about it a lot, and afterwards I just thought, you know what, I'm going to continue to sell call. I'm not sure if I'm right, okay? Of course, right now I'm just going to let you guys know right up front, I'm not sure if I'm going to be right. I sold calls getting a premium of about $6,000 or so, okay? So hopefully these $6,000 are all going to be going to my pocket for free, hopefully, okay? But of course, that will only be in contingent if the whole market basically just sideways trade for another 4 more months, which I highly doubt as well. Because I don't think that there's going to be a lot of sideways trading left in the second half of the year. I do think that there's going to be a lot more bigger movement happening, be it the stocks going back to the moon, aka just huge recovery overall in the whole entire economy, or the economy actually going into a recession. Okay, this is the year that we most likely will be able to see a recession happening or a huge recovery happening. Nevertheless, that's kind of what I'm expecting for this. Okay, so I'm just gonna keep it as it is for now. Let's move on to this one. Stocks futures slip as investors reassess Fed's comments. Okay, comments offer relief to investors who have become increasingly fearful that the Fed could raise interest rate too fast, and eventually tip the economy into a recession. That's has always been one of our fears as well. But by Thursday, investor optimism has begun to wane. Even with a larger interest rate increase off the table in the coming months, investors are still facing the most aggressive tightening of US monetary policy since 2000. The last time the central bank raised rates by a half point, many investors are now questioning how high the Fed might raise rates over the next 2 years and how that might ripple across the economy and corporate profits. So yeah, like I said, I do think that ultimately a lot of investors are still going to be concerned. One of the reasons why I also sold calls on my own portfolio as well. I'll be going through some of the earnings later on as well, which is obviously the most important one, which is Etsy and eBay. I think that's going to actually give us the whole outline of the whole e-commerce side of things. Of course, with Shopify actually giving us a little bit of a foreshadow to begin with. But I do think that eBay and Etsy is going to be a better, clearer view for the whole e-commerce side of things. All right, so next up we have Fed, Biden administration float new lending rules for lower income areas. I do think that this is a little bit worrisome. Okay, this is going to be tipping towards politics side of things because they are speaking about Salt Lake City and such. But I do think that ultimately, I don't really want to get into the politics of these kind of things, especially, which is why I'm not talking about the abortion side of things. I'm not talking about Elizabeth Warren side of things. All these, I do think that is going to be very divisive, and I don't think I want to be talking more about them. But I do think that, the Feds and the Biden administration floating new lending rules for low income areas was a little bit of an interesting news for me. Because when you are actually having new lending rules for low income areas, it simply means that you are trying to stimulate the housing market, which is something that I like to talk more about. So yeah, I do think that if lending rules kind of wane off a little bit, there is a good chance that we might actually see more of a boom in the housing market, be it even in the lower income areas. If you're not talking about your LA, you're not talking about your California and such. I do think that, maybe your Missouri side of things, or your Salt Lake City side of things, or Florida, all of them, you might start to see a little bit more of a booming housing market, which honestly speaking is not something that we really need right now either. All right, so next up we have Elon Musk. Kathy would say passive funds have gone too far. All right, so Elon Musk and Katie Wood criticized passive investing in a Twitter thread, weighing in on the long-running Wall Street debate about the growing power of index funds. So basically, Elon Musk replied to Katie Wood. Let me see if I can get the tweet out here. Okay. All right, so let's see. All right, Kathy Wood, basically, passive funds prevented many investors from enjoying a 400-fold appreciation in Tesla from a $1.6 billion market cap at its IPO in June 2010 to $650 billion when it entered the S&P 500 10 years later in December 2020. According to ARK Investor Research, most broad-based passive funds are short disruptive innovation at a time when the global economy is undergoing the largest technological transformation in history. In my view, history will deem the accelerated shift towards passive fund during the last 20 years as a massive misallocation of capital. Of course, we have to take it with a grain of salt because Kathy Wood with ARK Invest, they are very, very into disruptive stocks and also tech and growth stocks. And of course, with Tesla being like literally one of their best performing stock, so it's kind of easy for them to pull that as one of the example for why they actually did a lot better than the index fund for that particular year or two. Okay. So over here, you can see, passive index investment is simply an amplifier of active investment. If active investment signal degrades in quality, passive is proportionally impacted. Also, if there are very few actual active investors, their decision can greatly increase companies' valuation volatility. So what Elon Musk basically is saying here is because it simply means, okay, honestly speaking, it simply means that we need more retail investors. Okay, because the thing is that if we do not have enough retail investors in the market, basically all the numbers are going to be cooked. Okay, we're going to go back to the dot-com bubble all over again. Because if you have a lesser active investors, aka only the institutional, which basically they kind of share information here and there anyway, all this decision can really suddenly just spike up a company that got zero earnings all the way to $17 billion, like pets.com. And of course, this is going to be creating a lot of volatility if there's not a lot of active investors. Of course, if you were to introduce retail investors into this whole entire mix, then, you can actually also include short selling. You can include selling or buying of puts and such like that. So there's going to be a lot more volatility going against those kind of pressures. Which is why it's very, very important for retail investors to still be around, okay, instead of just going with the index funds. So that's basically what they're actually talking about over here. And yeah, meanwhile, there's been there's been a hidden human hand behind most passive strategies, from writing the rules of every index to deciding how each fund will run. So yeah, ultimately, index funds index fund is not exactly that passive, and that's kind of what they're actually talking about in this article. All right, so next up we have Shell. Oil giant Shell reports highest quarterly profit since 2008 on soaring commodity prices. So of course, Shell, we all know about Shell. They are one of the biggest oil giant in the world, and not only did they report highest quarterly profit since 2008, they also increased their dividends, which is quite good for their company. Okay, following soaring profits seen across the oil and gas industry, UK rival BP on Tuesday announced plans to boost share buybacks after first quarter net profit jumped to its highest level in more than a decade. Then afterwards, they actually reported a sharp upswing in full-year profit in 2021 and rebounding oil and gas prices, with the CEO hailing it as a momentous year for the company. I'm pretty sure that they're going to be talking a little bit about the dividends over here. Let's see, do they post-tax Ukraine full year? Okay, they actually didn't talk about a dividend, but I did read up briefly about how Shell basically started to give out dividends or more dividends because of their new quarterly profits. I think that's kind of like a good news sort of thing. But of course, that's going to be bad for me because I still have a short position on Occidental Petroleum, which I'm not going to lie, I do think of adding more to that position simply because I don't think that Occidental Petroleum is going to be staying at above $60 for super duper long. All right. Next up, we've got Facebook planning to reduce the hiring as the revenue growth slows and inflation concerns increases. So, of course, right now you look at the pre-market, Facebook is kind of down by 1.28%, kind of bad. But of course, understandable because of hiring slowdown. Okay, this is a huge thing for big companies, especially for Meta. Okay, especially for a FANG company. Sees challenges ahead because of the Apple privacy changes and the war in Ukraine and broad and macroeconomic shifts. The company plans to stop or slow the pace of adding a mid-level and senior people. I do think that ultimately, like I said before, if you're talking about a FANG level company, hiring slowing down being a report is going to be detrimental to a company no matter how it is. Okay, especially for a big company. Okay, if a smaller company, maybe you're talking about Peloton or you're talking about like Palantir or whatever of that case, I do think that it's going to be easily shunned away. But for a FANG level company, it is definitely going to have a lot of scrutiny over it. So that's something that we have to really look at. All right, for last news, okay, before I actually have to go off, the last news: eBay and Etsy drop on weak guidance as e-commerce crunch continues. All right, so over here we can see for Etsy, the earnings per share, they actually did a meet on a 60 cents expected. Their revenue went up 579 million versus 575 million. Pretty good. Okay, you beat by $4 million. Afterwards, you have for eBay. eBay actually beat on earnings as well, 2 extra cents, and then revenue they actually beat by $20 million. So yeah, pretty good and all. But what is actually scary about this is because of their guidance. Okay, so let's see if we can find the guidance for this. And honestly speaking, okay, ever since the last 2 quarters ago, we have realized something very, very important. Okay, which is company guidance are going to be one of the most important things that we are going to be looking at in the entire earning report. Honestly speaking, because if you remember what happened with Netflix 2 quarters ago, Netflix reported a beat. But the guidance alone simply just destroyed Netflix and basically paved whatever is left of Netflix for right now, which is why that was the scary part of Netflix at the time. All right, so right now we really need to look at the guidance. Etsy said that he expects second quarter revenue to come in between 540 million and 590 million, which is below the 628 million forecast by analysts, which is why it's quite a huge marginal difference. Because previously we were expecting, even by the analysts, I was actually expecting somewhere in the north of $650 million as well. So I do think that with them actually forecasting 540 to 590, I do think that that's going to be a little bit dangerous. For the revenue side of things, they're expecting it to be 2.9 to 3.2, whereas analysts forecast $3.4 billion. And honestly speaking, that was actually very, very, very worrisome. And for eBay, they are actually, showing the quarter revenue to come in between $2.35 billion and $2.4 billion, implying a slowdown of 9% to 7% year over year. The Wall Street projected second quarter revenue of $2.54 billion according to Street account. So yeah, we kind of expect that if that's the case, e-commerce or basically e-commerce business in general are definitely going to be getting destroyed even for the next quarter as well. And let's not forget, okay, these are just guidance alone. And if Etsy and eBay fail to meet this expectation, I'm not talking about beating. Okay, I'm not talking about beating expectation. Okay, an expectation beat is already something that I kind of don't want to expect from companies. Just meeting the expectation alone is going to be a little bit worrisome. And what I'm afraid of is that if they do not even meet and they even miss on this sort of guidance, then that's going to be very, very troublesome for the whole entire e-commerce section. Anyway, that's all I have for today's news. Thank you guys so much for watching, and I'll see you guys tomorrow.